Real estate investment trusts or REITs have been a very popular investment class that Singaporeans have invested in. And today, I'm going to review my entire Singapore REITs portfolio so that I can share with you what have I invested in, and we could probably learn some lessons from each other. So stay tuned and watch till the end so that you can know my entire REIT portfolio and how is it suitable for you. What's up guys, it's Christopher here, back at Honey Money SG. And in this channel, we are all about building financial knowledge, teach money saving hacks, and also help you lead a fulfilling quality of life. So if you're new here and these topics interest you, consider subscribing. Alright, first up, what is REITs? Real estate investment trusts or REITs are companies which manages portfolio of income generating assets, specifically properties, like a landlord who finds tenants to rent its space for business usage. Now, why are REITs a popular asset class held by a lot of investors? Because it allows us to actually invest in a property through shareholdings, and it is also generally stable coupled with consistent cash flow distributed in dividends. So how can you invest in a REIT? You can own REITs by buying their individual stock tickers through your respective stockbrokers, or ETFs like the Lion-Phillip REIT ETF, or even through your Robo Advisors like Syfe REIT Plus. Before we start, let me put a disclaimer here that I am not a professional investment advisor, neither is this channel tilted towards investment training. So this is just my very layman opinion of a very simple investment approach, and by no means I am asking you to copy me, but what I'm trying to do here is I try to explain the concepts as simple as it is so that it is easier for you to understand without getting too technical on the terms. If you are pursuing financial independence just like me in this video, I'm sure REIT will play a very important role in your investment portfolio, because REITs can help you secure a consistent cash flow for your daily spending expenses, although it returns slightly lower than growth stocks traditionally. And when I'm looking at REITs, I'm only looking at two metrics: distribution per unit, or DPU. Is it increasing year on year? So distribution is basically the REIT term of dividends, and is how much the company pays you every quarter or every 6 months out of their cash balances. So generally, if a REIT company is strong, it is able to generate consistent increasing dividends year on year, and that signifies that the company has a very good growth story on the dividends side. Now, the next metric that I look at is the cash flow from operations. The cash flow from operations, or the operating cash flow, is a metric that I look at whether the business is generating money from its normal business operations, and it strips off any kind of accounting adjustments, so we are looking at the raw business. So it ignores facts like accounts receivable and depreciation, which are not cash generating activities, and it will actually impact whether the company is able to pay its dividends or distribution going forward in the future. Now, I know that there are a lot of investment gurus who may be wondering that what are other metrics like the occupancy rate, the weighted average lease expiry, so on and so forth. Those are going to more technical terms already, but just for the simplicity of this video, I will exclude it for now. If you are a beginner into REIT investing, then I believe these two metrics will be good enough for you to sieve out bad companies that you should not invest in. With that said, I hope you all can learn something from this video and give an early thumbs up. Let's move on to the first REIT that I own in my investment portfolio. Stock ticker number 1, BUOU, for the Frasers Logistics and Commercial Trust, or FLCT in short. Now, I have 3,000 shares of FLCT, valued at $1.47 at the time of recording, so that translates to $4,410. FLCT generally owns logistics and commercial properties across the UK, Netherlands, Singapore, and even Australia, and actually most of its properties are physically located in Australia. In terms of fundamentals, I consider FLCT being strong because the tenants are renting for office space, industrial manufacturing activities, and also logistics, warehouse and supply chains, which are more defensive in nature and not cyclical with the economy. In another news, FLCT is actually being included into the STI ETF index from 13th April of 2021. What that means is that it will bring in more trading volume as more institutions and retailers buy in the STI ETF. And that is a piece of good news actually. If we look at the DPU or the distribution per unit for year 2020, it returned at around 7 cents, which is 4.8% yield on the cost of $1.47. If I were to pull in the historical distributions of FLCT, you can see that the dividends are actually fluctuating quarter on quarter or even year on year because of the fluctuating AUD depreciation, which has not been in their favor for the last few years. But recently the currency of AUD have been slowly growing and being more stable, and that brings a more consistent and growing dividend for FLCT. Now let's look at the operating cash flow of FLCT. You can see that year on year it has actually grew by 51.3%. That signals a very good growth generated by the business operations of FLCT, and it's a good sign for you to invest in it. Coming up at number 2, we have stock ticker AJBU, Keppel DC REIT, or call it KDC in short. I have 2,000 shares of Keppel DC valued at $2.72, and that makes it a total value of $5,440. Now KDC is a 100% data center focused REIT. So what they do is they rent out their spaces to companies to house their computer systems such as networks, data, storage, telecommunications, and backup, which are crucial to support the company's operations. Now, data centers are considered highly defensive in nature because the switching costs and the barriers to entry are high. It's not just the equipment itself, it's also the facilities costs involved for the setup. You will need to have uninterrupted power supplies, cooling systems to ensure that the equipments are well ventilated and cooled, and also secure enough so that it will not be prone to any kind of sabotage. This means that if companies are considering to switch data center locations, it will be very costly to move because it involves setup costs. So very likely tenants will just stick with the current existing location for their data centers, and that provides a consistent revenue stream for Keppel DC REIT. If we look at the DPU for last year, it hovers at around 9 cents for the full year, and that represents a 3.4% yield on the cost of $2.74. And looking at the dividend history, it has been increasing year on year. In fact, one of the highest increasing growth DPU that we have seen in the REIT. That also signifies that the economy is moving towards a tech-driven environment, and there is higher demand for such data centers. Now, if we look at the operating cash flow, it is also a year-on-year growth of 51.3%, ending at $235 million of cash flow in the year of 2020. Now, this is considered a very good operating cash flow, looking at how high the cash balances are, and definitely a strong company to invest in. Next up in the list, we have stock ticker M44U, Mapletree Logistics Trust, or MLT in short. For MLT, I have 4,000 shares valued at $1.95, and that translates to a value of $7,800 in MLT. Now, MLT owns logistics properties like warehouses and distribution centers located around Singapore and some of it in other countries. If you are a fan of e-commerce, you will know that e-commerce has actually supported growth of logistic warehouses because there is so much demand for logistics warehouse space to store e-commerce inventory. And these kind of properties are not really affected by the pandemic because logistics operations are considered essential services and are allowed to continue to run operations because they are so much integrated into our lives. As long as the e-commerce markets continue growing, I believe logistics warehouses are here to stay for the long term. So looking at the DPU, we have around 8.5 cents for the year of 2020, which is 4.4% yield on the cost of $1.95. Similarly, we can see that the dividend is increasing year over year, and that signifies a good growth story. If we look at the operating cash flow, it has grown year on year 4.3% at $369 million. No double digit growth year on year, but consider the high operating cash flow numbers that we have right now, I think that is a very favorable score. Second last on the list is C2PU, ParkwayLife REIT, or PLIFE in short. For PLIFE, I have 3,000 shares valued at $4.10, and that values up to 12.3k of investment in PLIFE REIT. So for PLIFE REIT, they own 3 hospitals in Singapore: Gleneagles, Mount Elizabeth, and Parkway East. In Japan, they own 48 nursing homes and 1 pharmaceutical manufacturing and distribution center facility. If you survive the year of 2020, you will know that healthcare is even more important right now, and it has a naturally defensive nature, so it's not really affected by the economic cyclical seasons. And since I bought this REIT for a few years back, PLIFE REIT is the only one REIT that does not have any rights issue or preferential offering, and this means that their financial management is prudent enough such that they don't need to ask shareholders to cough up more shares for their business decisions. If we look at the full year dividend of 2020, PLIFE REIT actually returned 14 cents, which is 3.4% yield on the cost of $4.10. And then looking at the dividend distribution history, you can see that it is also increasing year over year, another strong REIT for DPU. Okay, but if we look at the operating cash flow, it is rather flat year on year at 1%, and also a slightly lower number of operating cash flow at 90.3 million. But I'm not too worried about these numbers as long as PLIFE REIT can continue to generate increasing DPU and deliver value to its shareholders. Final contender on the list, MEAU, Mapletree Industrial Trust, or MIT in short. So for MIT, I have 5,000 shares valued at $2.80, which sums up to a total value of 14,000 Singapore dollars. So despite the name of this REIT being industrial, its portfolio is actually quite diverse, with a mixture of data centers, high-tech buildings, business parks, flatted factories, and light industrial areas. MIT is actually one of the more aggressive REIT companies that is focused on growth. If we look at the portfolio since its initial public offering or IPO, you can see on this slide that MIT has so many acquisitions throughout the years, but that also means that it has actually offered many rights issues and preferential offerings to its shareholders, so you must be prepared to keep a stash of cash in order to exercise your rights and your offers. Because if you do not have the spare cash to invest in the rights during their exercise, you are actually being diluted as a shareholder. And more recently, in the last few years, MIT has actually have a stronger focus on data centers, which is the future trend given that we have more advancement in technology and more companies giving stronger focus on tech advancements. And you can also see strong efforts of MIT being their strategy to convert older light industrial buildings and flatted factories to high-tech buildings and business parks. This means that MIT is actually well aware of the economic condition and the environment and well positioned to attract new tenants to rent out their space. Okay, so the DPU for MIT last year is around 12 cents, and that represents a 4.3% yield on a $2.80 cost. Slight fluctuation in the dividend distribution history last year, but the general trend of the DPU is increasing year over year. Operating cash flow is strong year on year at 17.1%, ending at $287 million. Fairly good results. Okay, so I've gone through the 5 REITs in my Singapore REIT portfolio, and let's put them all up in this table over here. Total portfolio value is $44,000. Weighted average dividend yield is around 3.8%. So that means that my annual dividend is around $1,672. And my monthly dividend will be around $139. Definitely not a huge amount of dividends considering the small portfolio that I have here, but enough to buy some additional stuff for the month. Alright, some closing thoughts here. I believe Singapore REITs are fairly good investment vehicles to park your money in, as long as they are run by reputable and well-managed companies like CapitaLand and Mapletree. And if you think my Singapore REIT portfolio is very small, that's because I have a larger portion focused on growth investing stocks in the US market. And when I move closer to retirement age, I may sell some of my growth stocks in the US and maybe put more of them into Singapore REITs because I believe they are a good cash flow vehicle to generate passive income that provides me a more consistent cash flow and less volatility in the prices. Okay, so today I have shared my very small Singapore REIT portfolio, and I hope that you have learned something out of it. Remember to like this video at the bottom and subscribe to my channel. And if you're more focused towards growth or index investing, you can take a look at my video over here. My name is Christopher, this is Honey Money SG, steering young adults to financial independence.